Hello and welcome. My name is Jeffrey Kennedy and welcome back to another episode of Elliott Wave Junctures. Today I actually want to talk about the fractal nature of technical analysis and more importantly the fractal nature of the wave principle. Now the price chart we have in front of us, this is a 10-minute price chart of Google. Okay, now whenever I'm looking for specific trading opportunities, probably the number one setup or the number one opportunity I like to look for, simply put, is a three-wave move within parallel lines. This is a counter trend move, this is an ABC correction. In this instance right here, this is actually a zigzag. Now this pattern right here, which is also identified as waves A, B, and C, that's actually a flat correction. What I like to do, bottom line, is simply look for these patterns, these three-wave moves within parallel lines, and as you can see here, they tend to represent counter trend price moves that are more than fully retraced once complete. These are the trading opportunities I like to look for. Now again, one of the powerful things or powerful aspects of not only technical analysis in general, but also the wave principle is that I can look for this very same, very specific pattern on multiple time frames and in multiple markets. And they all mean the same thing. That's what I think is so powerful and dynamic about technical analysis and why I think it stands many times head and shoulders above quantitative analysis or fundamental analysis. As you know, with respect to financial analysis or market analysis, there's primarily three disciplines: fundamental analysis, quantitative analysis, and technical analysis. Now, I think each discipline actually brings something to the table for the analyst and for the trader, but with respect to technical analysis, I have yet to find another tool that allows me to look at, say, 20 markets and be able to do so quickly and be able to do so accurately with respect to identifying opportunity. Next, let's take a look at Google again, but now we're going to go to a 2-minute price chart. And again, here's that same picture. Here's that same fractal pattern that I like to look for. A three-wave move, ABC, within parallel lines. It's a counter trend price move that tends to lead to further rally in this instance. And here's another example of another ABC decline that again was more than completely retraced once it was complete. So bottom line, again, with respect to the wave principle, those corrections, those 5-wave moves, those 3-wave declines, just as they form on the 2-minute price chart, they form the same way on the 10-minute price chart, and the same way on the 60-minute price chart, and even on the daily chart level. Here's a great example. This is DirecTV, ticker symbol DTV, and look what happens, what's going on in this market. A nice 5-wave decline off the actual high here back in 2011. Subsequent price action is a 3-wave move contained within parallel lines. This is the same structure here, just as we saw on this 2-minute price chart of Google. A 3-wave move within parallel lines. A 3-wave move ABC within parallel lines. And just as we saw on the 10-minute price chart, ABC, parallel lines, ABC. Okay. Now, also too, again, because it's fractal, we look at these we look for essentially the same pattern, regardless of time frame, be it a 1-minute, 2-minute, or 3-minute price chart, daily level, or monthly. This is the NASDAQ 100. This is an impulsive decline off the high here back in 2000. A subsequent advance is an ABC, and it is within parallel lines. And essentially what we've done, if you're familiar with the Kennedy channeling technique, we've come right to the upper boundary line of the corrective price channel. 3-wave patterns are very significant, regardless of time frame. And this is exactly what I look for whenever I'm looking for opportunities. And as you can see here in the NASDAQ, as well as in DirecTV, we have 3-wave moves across the board. Just something to consider.